what happens with Android is Google makes phones now, but Google phones are only 1 to 2% of all of the Android devices out there. And something similar is happening with Ethereum, where today now just 1/6 of the transactions that happen on Ethereum are happening on mainnet, but the L2 space is early and proliferating rapidly. And so I think we can easily imagine that in the near future, only 1 to 2% of all EVM transactions are ultimately going to happen on Ethereum mainnet.
Hey Joel, welcome to the Open Metaverse podcast.
Thanks for having me, Mehdi.
Joel, to kick things off, why don't you tell our audience a little bit about yourself, your crypto origin story, and placeholder?
I guess the story started back in 2013 or so. I was working for the government of the Dominican Republic on tech policy. Among those things included payment system reform. And I spent a bunch of time trying to figure out how to modernize the payment system of an emerging market, and started looking then more broadly at Latin America, and quickly figured out that we really needed a brand new technology infrastructure to really do payments at scale. And that's how I found and fell in love with Bitcoin. And then a short time later, I got a little tired of working for a government and moved to New York and joined a venture capital firm called Union Square Ventures, who had just invested in Coinbase and had been developing an interest in the technology. Those 3 years that I spent at USV were really instrumental in developing a deep understanding and conviction around what we can really do with this innovation. And then fast forward to 2017, my partner Chris Bernisky and I had spent at that point a year thinking about how to invest in this space and how it was going to evolve, and we made the decision to start Placeholder Management, which is our firm. We're a venture capital firm that invests in primarily in decentralized protocols, but really with a focus on decentralizing data, wealth, and power, which is our driving principle. And so we've been in business since 2017. We're now deploying our third fund, and together and before our time at Placeholder, we've really been working in this industry now for almost a decade now, which is pretty amazing. And everything that we've seen over the past 10 years is nothing short of astounding.
Great journey, Joel. By the way, big fan of your writing as well as Placeholder's writing. And
Thank you.
And I recently saw that you've written a piece, I think after a few years. The premise of that piece is Ethereum is like Android and Solana is like iOS. I would love to unpack your thoughts there and the whole article.
Sure. Well, we can go really far back to add some context here, because back in, I think it was 2019, I wrote another short piece called Ethereum and the Seven Dwarfs. And in that one, I explored the similarities between Ethereum in the 2019 era, now Ethereum had been around for about 5 years, to IBM in the mid-70s, when IBM had been in the mainframe computer business for about the same time, for about 5 years, a bit more. And at the time, IBM was by all means the dominant mainframe provider and computer company in the world. And there was a saying back then that it was IBM and the Seven Dwarfs, because you had IBM as the leader, and then you had 7 other computer manufacturers at the time that combined didn't even sum up to IBM's scale. And so what was interesting about that time is that you had a lot of people challenging IBM, but really couldn't match its distribution. And so at the time, it really was Ethereum who was running the table, and then you had a number of upstart networks that were trying to take market share from Ethereum, but were just getting started. And so there were some market structure similarities between Ethereum and those upstart networks, which included networks like Solana and Avalanche and Polkadot and Cosmos and a number of others, many others that at the time were called Ethereum killers. And so it really felt at that time, and it turned out to be, that Ethereum was the dominant place to build on and the best place to invest at. However, it's now been about 5 years since, and similar to how we saw in the IBM era, as the infrastructure for computers matured and became more modularized and more standardized, then IBM started to lose dominance. Now, it continued to be and continues to be one of the world's largest companies. But what standardization and modularization and the maturity of the industry enabled was some of those competitors then started gaining market share years after. And something similar is happening with Ethereum and the Seven Dwarfs, where we're starting to see a shift where a lot of the innovation is no longer happening pretty much only on Ethereum, but it's now happening on top of some of these platforms who have now been around for about 5 years or 3 years, and so they're more mature. And so that's important because we have these shifts in market structure as an industry develops, and almost no industry has one single dominant player that dominates the market. As the market matures, we typically end up with 3 to 5 major players, and then a long tail of mid-level alternatives that tend to be more specialized. And so we see this in the browser wars. We see this in the operating system wars back with Windows and Mac and Linux. We see this with the cloud providers, and we see this with mobile operating systems and so on. The market tends to gravitate to 2 to 5 major players. And so I think we're entering that stage where we're going from lots of different options, because there's dozens of smart contract platforms, maybe hundreds, that all do about the same thing. But now, as the market's maturing, I believe we're going to consolidate to 3 to 5 major platforms. I believe Ethereum is going to be one of them, and we believe that Solana is going to be one of them, and a number of others. But the reason why I focused on Ethereum and Solana is because, and then I'll bleed into the comparison with iOS and Android, is that Solana is really displaying formidable strength in a bear market. And it's very similar to what we saw with Ethereum in 2018 and in 2019. The reason we developed so much conviction on Ethereum then was that virtually every entrepreneur that we were meeting in our venture capital work was building on top of Ethereum. And so we really got to know Ethereum quite intimately. And you work with some really smart, intelligent, careful people, and they make intelligent choices of platforms, and then it's contagious, and you get to learn a lot about the infrastructure. We're going through a very similar period with Solana, where we're increasingly making venture investments in that ecosystem, and that has been really feeding a lot of our enthusiasm on Solana. Now, in our work with those founders, what we see is that the direction that Ethereum is taking is very different from the direction that Solana is taking. And that's actually really encouraging, because the reason the market segments around 2 to 5 major players is that those 2 to 5 players make certain trade-offs that cater to different kinds of builders. And so, for example, Android, as I outlined in the piece, took an open source approach to the mobile operating system market. And instead of manufacturing the phones and vertically integrating the stack, Android runs on several different kinds of phones, manufacturers, devices, televisions even. And so Android is very flexible. And so Android to a large extent is primarily a developer platform, and then it's being distributed to end users through dozens of independent manufacturers. And so in the analogy here, which is a crude analogy, but it helps illustrate the point, Ethereum is becoming more of a platform for L2 networks to settle on and to rely on for security and stability and so on. But we're quickly shifting to a model where most of the users of Ethereum are not using Ethereum mainnet directly, but rather are using L2 networks like Polygon or Base or Arbitrum or CK Sync and so on and so forth. And so that market structure starts to resemble that of Android. And that what happens with Android is Google makes phones now, but Google phones are only 1% to 2% of all of the Android devices out there. And something similar is happening with Ethereum, where today now just 1/6 of the transactions that happen on Ethereum are happening on mainnet, but the L2 space is early and proliferating rapidly. And so I think we can easily imagine that in the near future, only 1% to 2% of all EVM transactions are ultimately going to happen on Ethereum mainnet, and most of them are going to happen on alternative platforms. That kind of model is really important for a lot of builders. And so if you want to build a phone, and ironically, Solana built the phone, Saga, and it uses Android as an operating system. Some people pointed out that that's kind of ironic, but it actually helps illustrate the point. If you want to build a phone or you want to build a mobile device, you get to save a lot of time and money by taking Android and using it as an operating system. And so today, if you want to launch your own network, you get to save a lot of money by deploying an L2 on top of Ethereum and leveraging the EVM instead of having to build all of that infrastructure from scratch. However, that creates a number of challenges. One is that the user experience from one network to the other can vary a little bit. And so even though they all use the EVM, they can be slightly different. And that's the same thing we see with Android, where Samsung's Android is slightly different from HTC's Android, which is slightly different from Google's Android, and so on. And so that's a challenge for developers sometimes, because you have to manage hundreds of different kinds of phones with different screen sizes, different processors, RAM amounts, versions of the software. And so developers on Android have to spend a lot of resources really targeting the lowest common denominator set of features to target as many Android phones as possible. But you have to spend a lot to optimize. By contrast, on iOS, because Apple has a more vertically integrated ecosystem, you get one SDK from Apple and one developer environment from Apple, and you don't have to spend a lot of your time trying to optimize for the iOS ecosystem. You sort of only have to build once and trust that it's going to run in lots of different places. And that's one of the main advantages for developers in the iOS stack. And so that's why it's often easier to develop for iOS than it is for Android. And that's why many companies launch iOS apps before they launch Android apps, because they get to market faster. And then in addition to that, the user experiences tend to be better on iOS, because all of the time that you save not having to deal with the complexities of Android, you can invest into user experience. The analogy isn't direct, but it's similar to what's happening in Solana land, where the user experiences that we're seeing in Solana are, in my opinion, superior to the ones that we see on Ethereum. And it's precisely because the developer doesn't have to think about deploying on multiple L2s and having to manage all of those trade-offs, doesn't have to think about gas optimization and spend a lot of resources trying to make the contracts cheaper to use and so on. Doesn't have to spend a lot of time dealing with the complexities of which wallets support which networks. And so onboarding on Ethereum is quite difficult in an L2 context, because you have to have a compatible wallet and you have to bridge between one network and the other. And so that's pretty complex for the developer and for the user. And it also creates opportunities for exploits and things like that. But in Solana, you can trust that it's just going to work on a single network, and any Solana wallet is going to work with your app. And so that's allowing entrepreneurs building on Solana to create much better user experience, in addition to the fact that it's a much faster and cheaper network.
Yeah, just to add on that, I think one thing very similar to iOS and Solana is that Solana virtual machine and the network itself, the L1, they're tightly integrated as well, like on a like leveraging the parallel execution on the hardware side. So we'll come to Solana in a bit, but one thing I wanted to explore with you was regarding the fact that you mentioned there could be maybe 2 to 5 big winners, and then there will be perhaps a tailwind of a lot of different blockchains. So do you think those blockchains will potentially exist as the L2 on Ethereum, or do you kind of see the market structure as such that maybe there'll be millions of blockchain, a lot of L2s, but market leadership will belong to maybe 2 to 5? Like, how do you kind of
Yeah,
think about that?
more the latter. And so um, I definitely think that we'll have millions of blockchains. Now, I'll put a nuance to it, and that's my current area of research that I'm working on. And really, one way to conceptualize L2s, particularly with the emerging modular archetype or paradigm, and with technologies like rollups in particular, those networks are interesting because they're not actual blockchains. And so a rollup isn't a blockchain. It's built on top of a blockchain, and so it leverages the security guarantees of one underlying chain, but it itself is not a blockchain. And so I'm starting to call these virtual blockchains because they, as far as a smart contract is concerned, the smart contract doesn't know that it's running on a rollup or that it's not running on an actual blockchain. And so the smart contract operates as if it's on a blockchain, but the environment itself is not. It's not really a blockchain. And that's interesting because it speaks to something that happens with technology infrastructure in almost any market, is that it becomes more abstract and ultimately more virtualized over time. And so, for example, in Web2, most applications today, for a number of reasons, they run on physical servers, but they're not actually configured to run on physical servers. They're configured to run on virtual servers. And so the container revolution that was ushered in by Docker and VMware in Web2 in particular had a lot to do with creating a virtual environment that the application is now contained in that virtual environment, and it simulates a server, but it's not itself a server. And then you place that virtual environment in an actual server, and then what that allows you to do is to shift that virtual environment around without having to reconfigure the application each time. And the reason I think there's an interesting analogy between virtualization in Web2 and rollups or virtual blockchains in Web3 is that virtualization was a scalability solution in Web2, and rollups and these virtual blockchains are a scalability solution in Web3 as well. But then that allows you to really have a lot more flexibility in how you deploy the infrastructure. And so what I think that's going to mean is that, as you pointed out, I think we'll have 3 to 5 major networks that are actual blockchain or blockchain-like networks that provide security and censorship resistance and all of the things that we expect from blockchains at a global scale that will also benefit from economies of scale. And then we're going to have a very long tail of virtual blockchains that will be either application specific or general purpose or sector specific or market specific or geography specific, and so on and so forth. The reason I think there's going to be millions is that I think we're getting to a place where, or heading in a direction where a virtual blockchain is the backend for any online service, and it becomes sort of the API interface to that service. And so something that we're seeing in gaming, for example, with some platforms that are emerging, is games having their own roll-up specific to that game. But then anyone who wants to build and connect to that game's API does it via smart contract connecting to that rollup. But it's not a game with its own blockchain; it's a game with its own rollup that simulates a blockchain. So that kind of makes sense. And another way that it parallels to virtualization in Web2 is, we have 3 to 5 major cloud providers. There's many others around the world, but 3 to 5 really major ones. And it's kind of a similar setup where if I build a Web2 app on using Docker, I now have this container and I can shift that application around from Google Cloud to AWS to Azure pretty easily. And so I think we're going to see some interesting developments as the modular stack matures, where you'll have L2s that settle to one or more of those major chains, and then those major chains become like the large cloud providers.
So TLDR, there'll be millions of L2s rather than blockchains, and consolidating on, let's say, few L1s. So potentially things like Solana, Aptos, like all of these blockchains could have L2s of their own.
Yes.
Yeah, that's actually very fascinating. I know Ethereum and some of the blockchains are going down that path, but I know few L1s that want to focus on composability tend to avoid that viewpoint. So it's fascinating to see that you're viewing it from that perspective. So Joel, I wanted to decode Solana, because I know there are a lot of things going on in Solana. But in your view, in terms of blockchain architecture and scalability, what makes Solana unique to things like Aptos, Sui, or Monad? So let's say for Aptos and Sui, we also have parallel execution. We also have a unique virtual machine. The only thing that's lacking right now is the ecosystem. But apart from that, like, what do you think is so unique about Solana that appeals to you?
As any market matures, the technological differentiation between platforms matters less and less, because they all achieve some form of feature parity. And so, for example, if you compare the major cloud providers, AWS, Google Cloud, Azure, they all provide the same functionality and have virtually the same APIs. They all do it differently, but the same thing. And so, for example, AWS has S3 for storage, and Azure also has a storage service. They're architected differently, but at the end of the day, the service to the developer is the same. Builders may have different preferences, or just what they were trained in is usually actually what drives decision making. And what tends to matter less is the architectural differences, and then what tends to matter more is distribution, community infrastructure, and developer infrastructure. And that, I think, is something that benefits Solana relative to some of the others. Now, we're also invested in a number of different smart contract platforms, and we think that there's going to be some really interesting competition among them. But what we're seeing with Solana that really has us really excited is the people working on the infrastructure are really delivering at a very high rate, and then have the advantage of now a couple of years of building and development and having gone through a cycle. And so the upstarts that we're seeing that are, in some ways challenging Solana, though the same way that the Solana or Solana and other networks of its generation were challenging Ethereum, are going to have the same kind of uphill battle. And so I think the architectural differences matter a bit less. Things like business development and community and ecosystem are going to matter more. Now, what's interesting is, for example, you have a network like Aptos, and they have been doing a great job at biz dev for, say, the media industry, whereas Solana's targeting a different kind of ecosystem, a different kind of network. And so I think one of the things that we're going to see over the next 5 years is that we're going to be competing less on the basis of technological differences and competing more on the basis of marketing and business development.
So, Joel, shifting gears a bit, I also want to touch upon tokenomics and value accrual of two architectures, the big ones like Ethereum and Solana. So right now, if you kind of have a look at both the ecosystem, it feels like Ethereum is focusing more on scarcity, and Solana is focusing on abundance in terms of the way that tokenomics is designed, in terms of the way they're kind of structuring their state. What are your thoughts on that? Do you think there's a correct approach? Do you think both approaches are reasonable? We'd love to download information from you.
I think they both work and are reasonable. Now, the one way that's useful to frame it is you have different concerns at different levels of scale. And so when you're trying to grow a network, you do have to do so on the basis of abundance. And when you are trying to then consolidate and scale a network, not necessarily in terms of like, let's call it horizontal expansion or physical expansion, but rather once the network is established and sort of operating at steady state, then what happens is that you want to consolidate the status quo, so to speak. So it's a little bit like, I'll use an analogy. It's a little bit like when a company is young, it spends a lot of its stock to build itself, in how it compensates, say, employees with shares of the company, or how companies may acquire other companies by issuing shares of itself, in stock transfers, et cetera. And so you're kind of in a capital expensive state when you're still building the business and the machine. But once a company is really mature and generating a lot of revenues and has a really strong balance sheet, then it has to spend less and less of its capital to achieve growth, and it can reinvest more and more of its revenue. That's in the business world. In the blockchain world, I think that takes the form of how the issuance model of a network is designed and structured. And so early on in the development of a network, in order to incentivize people to contribute to it and to invest resources in it, you do it largely through that capital expenditure, through issuance of the token. But as the network matures more and more, and you have more and more activity, and you have more and more, say, internal revenues or income, then you can start to shift to more of an income and operational income model, as opposed to a capital expense model. And so I think where Ethereum is heading now is Ethereum generates a lot of fees, and that allows it to have a token model that does not depend on issuance of ETH itself in order to compensate the participants in the network. But early on in Ethereum, you couldn't do that because there wasn't enough activity on Ethereum to compensate the participants purely on an income basis. Similar with Bitcoin, this was really, this has been one of the points of focus for Bitcoin for a long time. Bitcoin's designed so that the issuance decreases over time, and what should be happening is that you should see then the fees increase to shift that. And so that shift was built into Bitcoin. Ethereum has gone through a number of changes of its economic model as market, or not just market conditions, but the state of the network has evolved. And now I think Ethereum has a really interesting model where it's more algorithmic, where if Ethereum as a network is in a kind of recession, then it becomes inflationary, because then you can expend some of your capital into growth. But when Ethereum is in a boom time and you have a lot of activity and a lot of transactions, it becomes deflationary, and then it starts to take some of that capital out of circulation. I think Solana, as a younger network than Ethereum, still needs to be in that state where it compensates people largely through a capital expenditure. But I think it's very possible that over time, as internal revenue increases, then it can shift more towards a business model that compensates participants from revenue rather than.
So Joel, will this analogy be roughly correct? Solana, for instance, is like a growth equity sort of, and Ethereum is like a value stock.
Yeah.
Just to follow up on that, like in terms of your L1s, like when you kind of view it as an instrument, in terms of your mental model, do you view these tokens more of equity, commodity, money? Like in terms of that expression, like where do you think these tokens lie, like especially for L1s?
That's a very difficult question, and that's being debated at every court in the United States, it seems. My personal view is that they have characteristics of both, and that's part of what makes them unique. And I think I wrote about this maybe in 2018 when I was thinking about something called the crypto economic circle, which was looking at how how the token really ties to different parts of the network. And what's interesting is that the token is different things to different people in the network, depending on where you stand. And that's really the financial innovation here. has a lot to do with that. And so if you are a user, the token can be both a currency as it can be capital. Now, I'll pause there and put an asterisk on this. It really depends on the token model of the network. And so, for example, in Bitcoin, Bitcoin itself is not a capital asset within the Bitcoin network because Bitcoin is proof of work. The capital asset in the Bitcoin network is actually the mining hardware. That is the capital asset of the Bitcoin network, and it produces this output that is a currency within the network. And so the value of Bitcoin comes more from the scarcity and supply and demand forces than from capital dynamics. In a proof of stake network where the token allows you to participate in the production side of the network, then the token becomes a capital asset because that's how you then produce the resources of the network. And capital is really, this will be a gross oversimplification, but the helpful way to think about capital is it's very related to the production side of the market. And so thinking about proof of stake networks or similar or proof of stake type token models, or token models that are not necessarily proof of stake, but where the holders of the token are able to access some of the economic value created by the protocol or the network, those are more capital assets. Now, for example, I can have SOL tokens and not stake and not validate and not participate in that creation. And so to me, in that case, SOL is only a currency asset or a commodity asset and not a capital asset. But then to the validators who do stake, then it can become a capital asset. It's also a little bit like, one of the interesting things is this isn't actually new, because if you think of the US dollar, it can be, you can use it as a capital asset, or you can use it as or you can transform it into capital, or you can use it purely as a currency asset. And so it's kind of similar in that sense. What's hard is having kind of a blanket statement, because token models vary so widely across different kinds of networks. But this is probably the reason why it's been so tough to make the decision of whether a certain a token is a security or a commodity, or whether it's capital or currency, and so on.
Do you think because of liquid staking and restaking, these types of concepts that are emerging, even the mental models now will have to shift? Like Ethereum could now become more of a capital asset than, let's say, money. Like, do you think, like, what do you think about that? Like, because of these dynamics emerging?
Yeah. Well, I definitely think that Ethereum, first of all, became more of a capital asset in the transition to proof of stake. And then that is probably exacerbated by the shift to an L2 dominant model, where ETH becomes more and more of a capital asset. And then when you have liquid staking derivatives and then financial instruments built around the nature of that capital asset, it further reinforces its status as a capital instrument. And then it's kind of interesting because, if we fast forward, let's just imagine a world years into the future where you have billions of Ethereum users that do not hold ETH, because instead they are using applications through various L2s. Many of them are probably gasless networks. Many of them are using other tokens for expenses, or, we get to a place where your wallet is also tied to your debit card, and then it just pays for transaction fees as you go, and all the things that are coming up. And so ETH becomes increasingly invisible to the end user, and instead ETH is primarily used by the machines who then leverage ETH for security. And so, for example, the Coinbase's Base business model is the users on Base, conducting their activity, and then Base as a network essentially pays Ethereum. It's something like 50% margins. And so to some degree, ETH becomes kind of a currency for for the L2s to purchase or rent security and storage from mainnet, but it becomes less and less of a currency, and less the instrument that you use to exchange for other goods and services. And so I think that progression, that transition, further cements ETH as a capital asset.
Joel, you talked about machine, so we'll just use that moment to kind of like completely change gears. I heard you on Unchained podcast where you eloquently articulated your thesis around intersection of Web3 and AI. So I think I want you to like explain that to our audience. Like, how are you kind of thinking about native Web3 AI business models? How are you kind of thinking about the emergence and convergence of Web3 and AI?
Yeah. Let's start with a thought experiment, or actually establishing principles. It's clear that there's going to be more AI agents than humans. Let's start with that. Vastly more. Because it's much cheaper to create an AI agent than it is to create a human. And so, how many more, I don't know, but orders of magnitude, or, millions of orders of magnitude, because we'll be able to instantiate these agents and shut them down at zero cost. And it's clear that these agents consume large amounts of information, and they get that information from the internet in some way, either because someone has consolidated it and given it to them, or because they're increasingly browsing the web and accessing information on the internet. And so I think that inevitably creates a scenario where we're going to see, say, I'm going to throw some really large numbers that may seem shocking, but I think are actually probably conservative. Let's say that we see a 1,000,000-fold increase in internet traffic demands. And so right now the internet is almost at 90% penetration globally. Human growth rate is pretty kind of stable around the world. And so demand from humans isn't going to skyrocket exponentially overnight, but internet traffic demands from AI agents, I think, is something that is going to take a larger and larger share of internet traffic, until the point that most of the internet traffic is being consumed by AI agents as opposed to actual humans. And so I know that these days I go to ChatGPT before I go to Google for many things. And then I see ChatGPT go and browse the internet and find out some stuff and then come and give me an answer. And so what's interesting about that is a Web2 infrastructure is not, at least immediately, prepared for that kind of increase in demand. And B, the Web2 business model isn't built for a world where 99% of internet traffic is driven by machines as opposed to driven by humans. And so that doesn't mean that we browse the internet less. It means that the machines browse the internet so much more than we do. And so if you think about all of those things combined, then you start to see how the Web2 business models and the cost models then start to break and start to crack. So when OpenAI released browsing a couple of months ago, they had to shut it down after a couple of weeks because Web2 companies couldn't really cope with what that meant. And we're at the very early stages of this. Twitter had to really kind of clamp down and limit public access to the network. And it's because then for Web2 providers, the cost of servicing all of that traffic demand then increases rapidly, but AI agents don't click on ads and you can't profile them. And so you can't, and they don't subscribe to content creators or anything like that. And so you then get this rapid increase in cost, but then you don't get the revenue that is associated with it. So that creates a set of interesting opportunities, because it means that the companies that remain in that business model are going to shut themselves off to AI, and then they might try to promote their own and build their own and have exclusive access, and that's something that we're going to see. Or they're going to make it really expensive for people to access. And so, for example, some things that are unrelated to this but that are part of the trend is Twitter's API pricing changes that shut down a lot of applications from being able to access it because it's too expensive. Reddit did the same, where it shut down a lot of its developer ecosystem not by shutting down the API, but by increasing the pricing to where they don't lose money on it. And so what that's going to mean is that, well, one thing is that AI agents are going to have to consume information from people that are willing to give it to them. But it also means that we're going to need an entirely new business model for online services to deal with AI. And the reason I think crypto is a big part of the solution to that is on the infrastructure side. I think decentralized infrastructure, where you distribute the cost of the infrastructure, is better suited to handle a rapid increase in demand from AI agents than Web2 infrastructure is. And that's a very high level comment to make. But a lot of it has to do with who bears the cost of it. And so in a decentralized network, the cost of the infrastructure is distributed among a lot of independent people, as opposed to being concentrated in one company. And then the other thing that's most interesting is, well, how could you implement the model where, okay, I'm going to allow an agent to come in and consume information from me, but I have to charge that agent some amount of money. And so an agent can't sign up to the Twitter API and swipe a credit card to get some API tokens to get some data. That's not going to scale. But you can have a smart contract in the middle where the AI agent goes to consume some information and makes a micropayment to receive that information, and then uses it as an input for whatever the AI agent is trying to do. And so I think that's a lot more sustainable and correct, where we tried microtransactions in Web2 many years ago, and it didn't work because humans don't like making microtransactions. But microtransactions make a ton of sense in an AI agent driven world. And so where I think we ultimately end up is we're going to have these billions and billions and billions of AI agents browsing the web and talking to each other and paying each other for information as they go around trying to figure out how to do their tasks. And then they bring that information back to us. And it only seems natural to me that economy runs on blockchain networks as opposed to the traditional financial system. I just can't imagine that working, on top of Visa or MasterCard. It's just never going to work.
So, Joel, how, as an investor, how are you thinking about expressing that? When you kind of told me this story, I kind of feel like account abstraction, intent-based architecture, those were the few things that are just popping in my head, or making infra for, let's say, equipping these agents with crypto wallets or trying to do all of that stuff. So how do you think one can express this? How are you thinking about it?
Yeah. So you touched on one area that I'm very interested in, which is wallets for machines. And there's two interaction models that I think make sense. There's probably more, but I can think of two basic ones. One is where, and what this would be relevant to account abstraction. One is where you authorize an agent to spend on your behalf. And so that's one where, you have a wallet with your keys, but then using account abstraction type of technologies, then, you instruct your agent or one agent to do a task. It computes an estimate of how much it's going to cost to do that. And then it spends it from your wallet. And what's interesting here is that one of the reasons why we also need the decentralized infrastructure in the back end is that right now, OpenAI is vastly subsidizing the cost of ChatGPT for people, and all of these companies are subsidizing it. But we're going to have to move to an operational cost model where the agent is going to have to be able to pay for its own resources. And so that's something where infrastructure networks, like, for example, Filecoin is going to be extremely interesting, Arweave, and besides all the smart contract networks and all of the compute and training networks that exist on a blockchain network. A big part of the reason why the blockchain is really important is so that you can pay just in time for the resources that you need. And that's something that's going to be really hard to do under the traditional Web2 model. So in that scenario, that agent that's doing stuff on your behalf, let's say that it computes, okay, you ask it to execute some task, like book you a flight, to pick something kind of banal. And then it says, okay, I'm going to need these many resources to pay for the cost of my compute to go do that. And then I'm going to need this much to be able to communicate with these other agents that do the flight booking, that do the, checking of schedules and so on, because they're going to have their own resource expenses. It might tell you, okay, it's going to, I'm going to go do this for you. It's going to be about $5. And then, you authorize it from your wallet and then it goes. And so in that case, that's the account abstraction and stuff like that. The other interaction model is one where you have agents that are not necessarily tied to you individually, but are more independent, and that have their own independent wallets and their own internal balance. And I think of those as more commercial agents, where maybe you have one generalized flight booking agent, to use the same analogy, and it's perfectly trained to do flight bookings. And instead of spending on your behalf, it charges you money, and it has its own internal balance sheet that it creates. And so there, it's not spending your money so much as you're paying it. And those agents might be owned by companies. They might be owned by DAOs, for example. That's something that I think is really interesting, where a DAO can own a type of agent. And then more broadly, we might have some independent agents that nobody controls that run some decentralized infrastructure. And maybe some of the most capable of them will become, AI millionaires or billionaires and things like that if they turn out to be really important. And so that's one mode of interaction that I think makes sense. And then another way to express this into kind of concrete investment ideas is how are we going to interact with these agents? What is the user interface going to be? And I think wallets are going to play a huge role here. And so in both of those scenarios, it makes sense, at least to me, for that interaction to happen at the wallet layer. And so we're starting to see, for example, Coinbase Wallet having added XMTP messaging and wallet-to-wallet messaging is something that's really interesting, because it's sort of underexplored, in that people are still thinking about it as a way to replace WhatsApp or Telegram or iMessage. And I don't think that's the right way to think about the potential for these decentralized messaging protocols, but rather as the native communication mechanism for all of these agents. And so at the end of the day, if you're going to have agents running on decentralized infrastructure, you're going to need a decentralized way to communicate with them. And they're going to need a decentralized way to communicate with each other. And so all of the people who are working on wallet-to-wallet messaging, if you think of an agent having a wallet address as an identifier, and you know that this wallet address corresponds to this particular agent, and then you see that agent's actions on chain, now you have an audit trail of what this agent is doing online, what information it's consuming, and that's really important for security and privacy and auditability of AI. And then they might use these decentralized messaging protocols to speak with each other and to speak with you. And so that's another area where we're spending a lot of time researching and understanding and developing a thesis. And then ultimately the wallet layer, more and more wallets are implementing messaging and building chat interfaces into their apps. And so all of that is going to come together to power this new world.
Yep. All of this is very fascinating. Very, very fascinating. So Joel, recently, we have seen few very exciting Web3 experiments on DePIN side and SocialFi. We are seeing things like Web3 Glassdoor, Web3 OnlyFans, Friend.tech, and on DePIN side, we are trying to see decentralized Google Maps, decentralized Google. What are your thoughts on these? Are there any projects that you guys are looking into? And then what's the placeholders thesis and your view on these emerging networks that are being built?
Yeah. So people have been trying this for a long time. And so back before it was clear the ways in which we could use crypto, and I'm talking about 2015, 2014, 2016, we had the first attempts at decentralized Uber. We had the first attempts at decentralized Google Maps. We invested in one of them that's called Phone Space, that's still operating. We had networks like Steam, which a lot of people will probably not recognize, but it was the first or one of the first decentralized social networks that was kind of a Reddit. It had its own blockchain and it did all these things. And they didn't really make it all the way through here. And a large part of the reason has to do with just where we are in the market cycle. Steam had to build an entire blockchain for its service, and so it was very capital expensive for the stage of the market. Then the market was tiny, And so that's a common pattern in any new industry. So that was essentially the 90s for the internet. In the 90s, you had that same dynamic where a lot of the ideas that are in Web2 today, the largest companies, were ideas that people tried to do in the 90s. But you had a combination of really expensive infrastructure costs because you had to build the infrastructure in the first place, and too small a market. And so people did video streaming in the 90s, but not enough people had broadband, not enough people had computers. The servers were extremely expensive, and so you couldn't really scale it into YouTube. You couldn't start really YouTube until 2005, and it wasn't until the 2010s that it really became more and more dominant. And so I think a big part of what we're going through is a generational transition, as now the infrastructure is rapidly becoming cheaper and cheaper. The market is expanding, and these ideas become more and more viable as a result of that. And we should also include in that the expanding regulatory space as the rules become clearer and clearer, and so payments are easier and wallets are easier and so on. And so it's the kind of thing where anything that touches the physical world, it's a lot harder to scale than things that don't. Now, DePIN is kind of interesting because crypto has always been about DePIN. In that, Bitcoin is a decentralized physical infrastructure network because you have all of these data centers around the world processing transactions. And so that's not exactly new. But obviously, where we're taking this infrastructure in terms of the other functions that it can do is new. And so I would expect DePIN to start taking off more seriously now, actually, as a consequence of what we just talked about with AI demands. And so things that have been existing for quite some time, like Filecoin and Arweave, I think are going to be increasingly relevant. People who have been doing GPU networks now have a market that is increasingly demanding GPU capacity, whereas 5 years ago there wasn't as much demand for decentralized GPU or compute. And then as far as social, it's similar to that kind of transition in that Steam had to build an entire blockchain. Now you can build a social network on an L2, and it's much cheaper to do. And so I think that's what's allowing the new generation of social or SocialFi networks to focus more on user experience and product as opposed to focusing on the infrastructure. And so we're starting to see that new generation of applications that have better user experiences or more innovative user experiences because they don't have to build all that infrastructure themselves.
Yeah, I think those experiments are very, very fascinating. What I'm also seeing, at least on SocialFi, people are also experimenting with some of the concepts they have learned from NFTs and DeFi. Like Friend.tech has a bonding curve, and it's good to see all of these experiments and people borrowing concepts from different facets of crypto and trying to do something new. So Joel, do you also think because of the reemergence of some of these theme, RWA is also going through a revival because of the infrastructure being a bit more developed and us having a bigger user base and liquidity?
Yes. But perhaps more important than that is the regulatory aspect. And so that I think is the most relevant evolution for real world assets and tokenization in general. And the first hints of this is that the low hanging fruit for regulation around the world that everyone's pursuing and everyone agrees on is stablecoins, regulated stablecoins. And that's really important. And so, for example, the first layer of European crypto rules has to do with centralized and collateralized stablecoins. And we're seeing the same thing even in the United States. I think it's most likely that the first crypto-specific bill of law and regulation to be passed in the US has to do with stablecoins, and same elsewhere around the world. And that's the narrow point of the wedge. That's the Trojan horse into RWAs, because a centralized stablecoin is a real world asset, a tokenized real world asset. You have the whatever collateral is underneath it, government bonds or actual currency, is the thing that you're tokenizing. And the traditional financial industry's interest in blockchains has everything to do with tokenization and real world assets. And so I think um, the institutional revolution on chain is going to be largely focused on RWAs. Now, people have been talking about the institutions are coming for years. But the thing is, the institutions are always going to play with the technology, but they're not going to come until the regulations are clear. But we're now getting to the place where the regulations are, we have a lot of visibility into the regulations being clear. And so, for example, what we're going to see in the next 2 years as stablecoin regulations settle in is the banks are going to release their own stablecoins backed by their deposits. And they're already starting to do that around the world. And that's the first thing that banks are going to be allowed to do. And then the banks are going to be allowed to tokenize other assets in their portfolios. For example, JP Morgan, who has a very storied history with crypto, has been experimenting with blockchain stuff for a long time. They announced the JPM coin a couple of years ago, and people sort of just dismissed it. But they've kept building. And so now you look at JP Morgan's Onyx platform, and it's essentially an Ethereum network. It's not obviously Ethereum mainnet. It's a private Ethereum network, but they're using a lot of public Ethereum infrastructure. For example, they're using ENS, a fork of ENS essentially, in the Onyx platform so that they can identify their counterparties through ENS domains as opposed to wallet addresses. And they're starting to tokenize assets and collateral and bonds with other banks for interbank transactions. And that is real world assets. Now they're starting in a kind of private consortium type of model, but then as more and more institutions join, then ultimately consumer transactions will operate on these chains. And it's interesting to think about, going back to the L2 conversation that we had. I think a lot of these networks will ultimately become L2s of Ethereum, and that's how you'll be able to jump from JP Morgan's Onyx to HSBC's, whatever network they might have, and so on. So that's I think really interesting in how we're going to get the bulk of our RWAs out there, and then obviously people want to be able to pursue opportunities in the startup and innovation side of things, not necessarily the traditional financial side. But that's where we're going to see some of the competitive dynamics among the established financial industry and the startups.
Yeah, that makes a lot of sense. Yeah, one observation I would like to share is, like some of the crypto models, because of securities regulation, it's very difficult to get token value accrual. And we have seen like some experiment where we have project, like for example, Sorare, they cannot launch a token because if they accrued revenue to the token or cash flow to the token, it will be a security. So what they're doing is, in terms of the native business model, they want to get the value accrual right now in cash flows. And in terms of Web3, the native medium of exchange is stables. So I think that is also because of regulation that has just amped up the need for the usage of stable coins.
Well, I'll tell you something else on that, and sorry to interrupt. Another consequence of this architecture, where you have a relatively small number of core chains and then a proliferation of L2s, I think one of the consequences is that shift of moving away from native token business models to more cash flow driven business models. And so I think the first big, not the first, but the most prominent right now, I think Coinbase's base is going to showcase a lot of this dynamic where it doesn't have a token. I don't know, but I don't suspect that Coinbase is planning to add a token to it. But it generates a lot of revenue for Coinbase, and it generates a lot of revenue for Ethereum. And so as the infrastructure becomes cheaper and cheaper, you actually need the token models less and less, because going back to the conversation we had about when you're expanding and you need to expend a lot of capital to scale a network, that's why we were using tokens to incentivize people to come in and provide resources. when starting up a network and a protocol was very expensive. But as that becomes cheaper and cheaper, you need to do less and less of that. And also, as more users have stable coins or other tokens, and you can implement those business models as the market is larger, then you need that less and less. So that we're seeing that playing out in real time. And so the reason I mentioned that is that, yes, regulations might have a thing to say there, but I think the more powerful market forces actually have more to do with the market structure dynamics than regulation, in that it's just increasingly less necessary to have to issue a new token to incentivize people.
Yeah, that makes a lot of sense. So Joel, do you think in terms of that modular architecture, our data availability, execution, settlement, like instead of having a token, we can have value accrual in cash flow basis?
Yes.
Got it. So Joel, on the last segment of the podcast, and I assure you it's a fun one, it's a rapid fire round. So my first question is, Joel, what does crypto need to focus on right now?
Wallets.
Got it. Your pet peeve in Web3?
My pet peeve in Web3, confusing value capture with investment returns.
Oh, this is a good one. Last thing you put on in ChatGPT?
The last thing I put on ChatGPT, let me see. I asked, what are examples of Kenyan food?
So file question, Joel. What are some of the weird Web3 experiments you are excited about?
Oof. Politicians with tokens.
Very nice. I think we need to onboard them to friend.tech.
Actually, that's pretty interesting. Or politician.tech. That could work.
Yep. I kid you not, I've recently seen Web3 Glassdoor as well. Maybe I'll share the link with the audience as well. Like, there are very interesting and weird experiments happening in Web3 when it comes to SocialFi. So I'm looking forward to all the experimentation. Cool, Joel. It was a pleasure to have you on the podcast. I thoroughly enjoyed our conversation. I got to learn so much. So again, thank you very much for joining us.
Thank you. I appreciate the space.
This podcast is for information purposes only and should not be considered as financial advice. Any opinions provided in this podcast reflect the views of the speakers only.